Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Tuesday, April 29th, 2025, so we apologize. A day late. We like to get this done on Monday. Nonetheless, let's take a look at the economic activity last week, go through those metrics, and we have to say on balance, we are looking, as everyone is, economic activity. Is it slowing? Are we heading into a recession? And we'll just say from the economic activity reported last week, certainly does not look like that. So a few metrics. Starting last Wednesday, we had new home sales, much better than expected. It's expected to come in for March, 680,000, came in at 724. Probably the biggest and most positive surprise, durable goods orders, month over month for March. That was expected to come in at a positive 2%. It came in at a positive 9.2%. Now, there may be some pre-buying in March, tariff-related, that distorts it. We're not sure, and we won't know for the next couple of months, see how things play out. But that was an outstanding number. Last week, initial jobless claims, exactly as expected, 222,000. We had existing home sales. That was just slightly disappointing. Consensus 4.13 million, came in at 4.02. However, one metric that we've been kind of focused on, consumer sentiment, the Michigan consumer sentiment final number, it was expected to come in at 50.8, favorable, upside, 52.2. So that's great. Now, let's take a look at the Atlanta Federal Reserve and what they expected for first quarter GDP. And here's what we know before going through the chart. We know that consumer activity definitely tailed off in the month of January. That was negative. Month of February, it perked back up, and it looks like the month of March was pretty strong. So if we were just to guess, since the consumer is 70% of the economy, if we were just to guess based on that, we'd expect at least modest GDP growth. However, Atlanta Federal Reserve still thinks we're going to come in at a negative 2.5% for the first quarter. Here's a big delta. We talked about it last week, possibly the week before, is that the Atlanta Federal Reserve believes, maybe correct, the U.S. bought an awful lot of gold during the first quarter, which comes up as a net import. That's an import, and so it works against the GDP calculation. So they actually, fortunately for us, and you can see it here on the chart if you look really close, they superimpose a graph showing you what GDP growth would be X the gold factor. And so if you net that out, it's close to zero. It's still slightly negative. And I'll say the rest of the blue chip economists' consensus, it's still positive for the first quarter, 0.4, 0.6%. And again, with all the economic activity that we've reported to you that we look at, be very surprised if it were a negative in the GDP growth for the first quarter. Inflation expectations, slight uptick last week, not a big deal. The expected inflation rate over the next 10 years is 2.27, very modest, very manageable. We do have a Fed funds meeting coming up May 7th, I believe. The expectation is no cut. That probability actually went up last week with Jerome Powell saying they probably weren't cutting. So it was 85% probability last week, moved up to 92%. So rate cut pretty much off the boards for May. However, for the rest of the year, there's now greater than 50% probability that we will get a total of 3 cuts or 75 basis points between now and December. Lastly, let's just talk about corporate earnings. That obviously one of the 3-4 top drivers of the market. We're right now in the period where companies, S&P 500 companies, are reporting their first quarter earnings, and they've been really good. We've seen better, but this is still very good. 73% of the companies that have reported so far, which is 54% of the S&P 500, 73% have beat earnings expectations, and the earnings growth rate right now for the first quarter is 10.1%. That is really solid. And valuation, that's something many investors, economists, talking heads talked about 2 months ago as being a huge negative. as we're at 21 times forward earnings. Now with the pullback and continued stability, I would say, in corporate earnings, that S&P forward multiple is now under 20. It's 19.8 times. So markets last week responded very positively to the economic news, tariff expectations. So we continue to see a strong rebound from 2 weeks ago when things were looking pretty bleak. S&P 500 last week up 4.6%, led by the NASDAQ, which had been punished all year, but NASDAQ last week up 6.7%. So last week, S&P 500 again up 4.6, led by growth, up 6.4%. Value only up 1.7%. However, when we look at a year-to-date through last Friday, you've got the S&P down, call it 5.7%, led by growth down 7.7%, and value down only 60 basis points, 0.6. Also last week, international markets were strong, not as strong as U.S., but developed markets ex-U.S. up 2.7%, exactly the same number for emerging markets. So on a year-to-date basis, developed markets ex-U.S. up 8.2%, S&P 500 down 5.7%. Fixed income last week, solid week. The 2-year yield dropped 6 basis points, the 10-year dropped 9. So the Bloomberg U.S. Aggregate Bond Index up 0.7%. So now year-to-date, that Bloomberg U.S. Aggregate Bond Index up a very strong 2.7%. So economic data that is coming out this week. Today, we haven't seen it yet, but the JOLTS job opening number will be coming out. Now, remember this number at the height of inflation, at the height of things going crazy after COVID, had grown over 12 million. It is now down to 7.5 million is the expectation. Prior month of February, that came in about 7.6 million. A big day, we'll have a big day in terms of economic activity on Wednesday. We get the ADP job change. Now, that's not as powerful as the Fed's non-farm payroll. Nonetheless, it usually gives you a good indication of what corporations are doing. So for the month of February, that was an addition of 155,000 jobs in their survey. Expectation is only 108 jobs gained in the month of March. The biggest numbers coming out on Wednesday, though, will be PCE. That's the inflation numbers. And this, the lower the inflation is, the greater the odds are, the greater the flexibility the Federal Reserve has in easing interest rates. So the core PCE month over month for March, what we'll get on Wednesday, is expected to be up 0.1%. That was up 0.4% in the month of February. So inflation, it is kind of sticky, but it has methodically been coming down. So if that number does come in at 0.1%, that means the trailing 12-month PCE, price personal consumption expenditure index, will be up 2.6%. And recall the Fed target is 2.0, so we're rapidly approaching that. So we'll also get personal spending, personal income on Wednesday. The personal spending is actually supposed to be higher than what we saw in February. Personal spending February up 0.4%, expected to have come in at a positive 0.6% for the month of March. Personal income, however, that's expected to drop a bit pace-wise in the month of March. So month of February up a positive, very strong, positive 0.8%. That's expected to come in at a positive 0.4%. Thursday, initial jobless claims, a lot of focus on this. The numbers have been much better than most analysts have expected over the last 2 months. The expectation is we'll have 225,000 new initial claims. Last week was 222. Friday, probably the biggest day. Non-farm payrolls, this is the money ball. Last month, for the month of March, that was 228,000 new jobs. That was way above expectations. Great. That's expected to come back down to earth and come in at a much more modest 135,000. So if that happens, the unemployment rate is expected to be static at 4.2%. We'll also have average hourly earnings coming at the same time, and that's expected to be in line with what we saw for March, which was a positive 0.3% increase. So that is a wrap-up. economic activity, markets last week, what we expect this week. We thank you very much for joining us and hope you'll join us again next week. Thank you.